Hi, welcome to the technological trajectory panel. A little bit of housekeeping first. We're going to have a poll running throughout the session. You're going to answer either our technology stocks have appreciated too much and are overvalued, or whether technology stocks will continue to grow as we seek more innovation. And there should be information up on the slide here. In this panel session, we're going to try and answer the question, is 2022 the year to invest in technology? With us today to help answer this question, we have Professor Sam Turner, Chief Technology Officer of the High Value Manufacturing Catapult. He joined the HVM Catapult team from his role as CTO of the Advanced Manufacturing Research Center with Boeing, where he worked on a range of projects and capabilities, including the flagship digital facility Factory 2050. Hi Sam, how's it going?
Very well, thank you. Morning.
That's morning. And then we've also got Katharina Dulka, CEO of corporate advisory firm Stellar One. Stellar One's focusing on strategy and investment advisory in tech. She's also the co-founder and chairwoman of Diden, a Swiss fintech providing ESG assessment-powered AI. At the moment, she's particularly active in the fintech and medtech space, working with investors, tech corporates, and financial institutions on their financial tech and strategic development. Hi, Katharina, how's it going?
Good morning, thanks for having me.
And finally, but not least, we have Stephen Yu. He's the lead manager of the LF Blue Whale Growth Fund. Stephen started at Hargreaves Lansdown investment team before leaving in 2007. Previous funds he's directly managed or co-managed are Citywire's AA-rated Artemis UK Growth Fund, an Artemis Pan-European Hedge Fund, and New Star UK Gemini Hedge Fund. Currently, he's at Blue Whale, which he started in 2017 and now has over 1 billion assets under management. Morning, Stephen.
Morning.
The last 2 years have been an extremely turbulent time for the tech industry. In 2021, tech stocks, particularly in the US, hit record high valuations and investors flocked to lockdown stocks like Zoom, Netflix, Amazon, and Peloton. In 2022, a lot of these trends have now started to reverse. Inflation and subsequent high interest rates have hit the valuation of tech growth stocks, and a lot of the lockdown winners have quickly turned to losers, with valuations falling below pre-lockdown levels. But does this offer a possible entry point for investors? Possibly, but only for companies that can offer a lot more value. With the era of cheap money seemingly coming to an end, investors are going to have to be a lot more discerning about positioning their portfolios, but there are still certainly companies out there that will succeed and will make our lives a better place. With this in mind, I thought it'd be good to start with how the pandemic has changed our relationship with technology and which trends we think maybe were permanent and which were possibly a bit of a fad. I think I might come to you first, Stephen. I know you at Blue Whale, you sold your position at Amazon, so presumably you sort of didn't see as much potential for the e-commerce industry, which got so much attention during the lockdown. And maybe I guess, yeah, it'd be good to get your views on maybe that decision and then other sort of more positive decisions you've made at Blue Whale in terms of what direction you think we're going.
Yeah, thank you for the question, Arthur. I think the first one to start with is during the pandemic, I think a lot of trends that many companies were working on before have materialized. And I think that there was a point in time that some of these companies would be expected to dominate the industry. From that point onwards, given that they have got a lot of traction, such as e-commerce, TV streaming, food delivery, etc., etc. And I think as we come out from the pandemic, suddenly you realize there's a lot more competition in that space. So similarly, like if we are just referring to Amazon's retail business in the e-commerce space, that nowadays I think the option for us to shop online is a lot more compared to pre-pandemic, and I think that definitely instill quite a lot of competition and pricing pressure. And at the same time, I think if we are referring to the e-commerce space in particular, then that is definitely not immune from inflation or stagflation. When prices are going up a lot, our kind of budget for discretionary spend is going to come down a lot more from here. So that for that reason, we managed to exit our position in Amazon late last year. I think equally, I mean, there are many other companies that we deem as quite low quality, or maybe they are not going to be the ultimate winner. But I think on the back of that, maybe I will leave Arthur to maybe drive more question in this space. I think artificial intelligence 5G, in terms of the hyperscale cloud opportunity. I think those areas that we think is still going to come in the next 5 to 10 years. But I think in certain space, such as e-commerce or TV streaming or other sectors, you're going to expect a lot more competition, and hence that the return on invested capital will be a bit lower for shareholders going forward.
Interesting. Yeah, one question we've had pop up off the back of that is specifically has been around the Internet of Things and also the Internet of Medical Things, particularly in the metaverse. I'm not sure if you have a view on the metaverse. I know you were sort of maybe a bit discerning about Facebook, Stephen, the last time I talked to you in their prospects in terms of the Oculus, but what's your view on the Internet of Things, and then also what that means for the metaverse?
Yeah. Yes, thank you for that. So I think I'm a believer in terms of Internet of Things, which link to 5G, and then even like metaverse. I do think at some point we're going to maybe spend a bit of time in the metaverse ourselves. Maybe this conference will be held in the metaverse in the near future. But I think the challenge being is like how much time is going to take before we get there. I mean, theoretically, it's going to get to a certain kind of standard. It might take 10 to 20 years before we actually spend a lot of time there. But I think the problem for us with Meta or Facebook is they are spending a lot of money investing in this space now as we speak. But then it's not very clear whether they would be the ultimate winner, because at the same time, we know that Apple, Google, or even Microsoft are doing something in the metaverse. And I think so with that context in mind, and I think you need to be quite careful in terms of whether all this money is going to be fruitful for shareholders. And ultimately, I think when we decided to exit our position in Facebook or Meta early this year, it was a lot to do with the fact that they decided to firstly change the name to Meta in terms of the commitment to spend a lot of money there without any clear trajectory whether they are going to generate a profit. And then secondly, we really invested into Facebook beforehand in terms of the social media, the Instagram, the WhatsApp, the Facebook page, in the digital advertising stream. And we didn't invest into Facebook because we thought like it's going to be a good play in metaverse. And so I think if you ask me whether there's going to be any good opportunity in the metaverse now, I think it's quite difficult, because you're going to see so many different try and error, like different company trying to do something there, but then ultimately it might not be successful. So I think that's the reason why we didn't like Facebook so much. But I'm a believer of metaverse in time.
Yeah, I was wondering actually, with these huge tech stocks like Facebook, Google, Microsoft, they sort of have so many different parts of them. Like the advertising part of Facebook is almost like a sort of value business, and then they have this sort of huge speculative growth business with Oculus. Like, how do you find sort of making a decision about, you might really like Amazon's cloud business, and the cloud's probably going to be a really important part of our future, but then you don't like the e-commerce business that much? Like, how do you sort of balance those things off against each other when you're making your decisions?
Yeah, I think it's a very difficult one, because I think a lot of these big tech companies, they do have multifaceted in terms of exposure to different lines of businesses. Like even for Microsoft, I mean, they are quite big players in the gaming space through Xbox, but that's not the area why we invest into Microsoft. I mean, we really like the Office 365, all this kind of Office subscription stuff. So I think from an investor perspective, you have to make a decision on how material that part is going to be in terms of the growth opportunity, and then how much of the valuation that has been factored into account. But I think the problem with Amazon a little bit is I do agree that the AWS business is very high quality. We really like it. I think if we get spin out from Amazon in time, we would definitely be interested. But at the moment, some people would try to work out some of the parts for Amazon that, AWS is going to worth a lot more than a retail, so forget about the retail. But that's not really the case, because from a shareholder's perspective, a lot of the money that's been generated from the AWS business is actually going into the retail to fund the logistics, to fund the expansion. And so from our perspective, that we actually get a clean cash flow return from the AWS, because a lot of those money have gone into retail, which is the parts that we don't want. So I think maybe until the point that it become quite clear that we can actually invest separately in the cloud business, then yeah, I think Amazon's cloud business is in a very strong position.
Yes, thank you. I think also going back to sort of slightly for Katharina and the question about the Internet of Medical Things. I'm not sure if you know loads about the Internet of Medical Things, but I know you have a knowledge about sort of medtech in general. So I'm interested, Katharina, of your view on medtech, maybe how that sort of progressed during the pandemic, and maybe sort of what direction you see that going in the future.
Yeah, so obviously during the pandemic, the medical systems were under huge amount of strain. It was very, very difficult to keep up in the UK, but also in the rest of Europe from what we could see. And that really showed the necessity to invest in medtech, may that be diagnosis from far over the internet, etc., really for protection reasons, but also because it would streamline the whole process of actually getting a diagnosis and getting healthcare. So it really emphasized on the relevance of medtech in general in specific areas like, as I said, diagnosis.
There was one story that I saw recently with about the UK government signing that contract with Palantir around sort of using NHS data. I'm not sure if, I was wondering whether there's sort of, has there, I know the UK government eased some of their rules around sort of what data was available to manage during the pandemic. Do you think there's sort of going to be the pandemic will make any changes, sort of the way we manage data that can make sort of processing and like using big data to make advances?
Yes, to a certain extent, but I think it's less of a pandemic thing than more of a generational approach to how open we are with data. I think that people at the age of 18, 19 are way more willing to share data because they grew up with this data sharing model, Facebook, Google, etc. While when I speak to my parents about sharing their medical data, they're in their 70s now, they literally like, this is not happening. So less of a pandemic thing, more of a generational thing for me. However, I think that to a certain extent, the pandemic showed that there can be some advantages to sharing data. However, like I'm somewhat in the middle, right? I'm 38. I'm a little bit like in the middle of, okay, this is useful, but how much do I need to protect, you know?
Yeah, so you think it's just more of a sort of demographic thing, younger people are more
I think so.
online.
And there's also a strong cultural aspect to it. So I'm originally from Germany. When you speak to German people about sharing their data, they get very, very anxious about it. The more you move into the UK, US space, the less people are worried about it. So there's also a strong cultural aspect to that.
So which countries are sort of doing the best work in the medtech space?
I don't think there is a best work to this. I think there's specificities. And it's also very difficult to compare the US to a country like the UK or Germany or France, because the US is a whole continent. And in general, US investors are way more bullish about taking risks. So we've seen a lot of investments in the medtech space in the US that haven't taken place in the UK or in Europe. You know, it's like US is always on the forefront of innovation anyway. And then there are specific things of VR compared to diagnosis, compared to other things that are geographically specific. So I wouldn't say per se that there's, you know, one country or one geography better than the other. But traditionally the US is obviously way more published than any other country. Yeah,
investors are willing to take bigger risks over there, yeah, aren't they? Which is also why they've been taking a bigger hit with interest rates going up recently. I think I've got a question for Sam here. So we've got a couple of sort of questions for Sam. Thank you very much, Katharina. So the first one was around cybersecurity and particularly sort of, and then the second question was on battery tech and what sort of advances you foresee for battery tech, and then any thoughts with respect to implications regarding ESG. I don't know if you can speak on either of those topics.
Yeah, I'll start on, I think that the cyber crime was more in the crypto crime, which probably isn't my area of focus, but cyber crime generally. So my perspective is looking across industrial use of technologies, B2B. We are seeing a huge uptake and a huge uptake in changing the appetite of businesses to start deploying the IoT, AI, advanced visualization, mixed reality technologies. We've seen an increased uptake, which was forced during the pandemic, and an increased appetite to further invest, where actually, so in the UK, businesses have been a bit sluggish to invest. That does drive heightened risk of cybercrime, certainly. We're looking at more data going online as businesses are getting a greater understanding of the value. As Katerina was saying about individuals and medical data, the same thing around corporate data, product data. What's the opportunity and advantage of putting data into the cloud to generate insights, improve performance, new product or business model offerings, versus the risk of losing business critical data or even cyber hacks and accessing. One of the concerns around IoT in the cyber physical world is you're opening up physical assets actually now to cyber attacks. So there's a heightened risk and awareness, and I think the increased investment and adoption we're seeing in IoT, in analytics technology across the industrial world means hand in hand there has to be increased investment in cybersecurity technology. That's going to be, I think, a critical area because you can't really move forward with the analytics and applications without having the cyber protection in place.
Is it have you seen an uptick in sort of interest around investing in cyber protection in the last year or so?
Yeah, absolutely. Yeah, we're seeing, because it goes hand in hand with businesses. This is B2B looking at further investment in taking their data, putting it into the cloud to create value, maybe about productivity and performance insights, market insights. There's a number of ways in which businesses we're working with are creating value from streaming data, processing that, and putting it into looking at cloud analytics and AI solutions and pulling data sets. But hand in hand with that, they're looking hand in hand at cyber security protection. We are seeing growth in a number of businesses who are providing great solutions there, and it's becoming more sophisticated. Almost rule-based cyber protection a few years ago is becoming much more sophisticated, using AI, machine learning type solutions to develop cyber protection, cyber security systems. So we're seeing growth, and we're seeing forecasting an increase in demand, I think, because of the increased investment in broader digital solutions that require cyber security alongside them.
Is this sort of a case of just basically a sort of correlation between the more businesses are digitized, which is almost guaranteed, then the more people need to spend on cybersecurity? Yeah,
absolutely. Yeah. And the more sophisticated, the more complex and poorly understood by businesses the threat becomes, and the more sophisticated cybersecurity solutions become. So we're seeing some quite innovative solutions coming through as well, beyond the traditional, I'd say, more kind of rule-based approach to cybersecurity. So yeah, absolutely, that correlation is absolutely what we're seeing. Yeah, on battery tech, that's still a huge growth area. Clean energy is the big clean growth area, and battery tech is a huge part of that. So we're seeing increased investment, a number of solutions coming to the market. It's quite an exciting space. I suppose the challenge around battery tech is going to be around material sourcing, lithium in particular, and bearing in mind battery tech is supporting a low carbon clean energy market, and we need to look at the energy intensity of material sourcing as well for battery tech. So, but it is going to be an increased growth area alongside other energy vectors such as hydrogen. So yeah, for now, battery tech looks like a really a strong area.
The thing that I'm always curious about battery tech is it seems like it's sort of they make so much progress and then stuff becomes obsolete really quickly, and then obviously we have issues at the moment a bit with the raw materials and getting access to those raw materials, and maybe that will become even more difficult in the next year or so, given the sort of wider geopolitical tensions.
I mean, that's true. If you think about battery tech in automotive, for example, you're looking at most internal combustion engine vehicles, and the engines look pretty similar. There's been rapid evolution and standardization over time, and battery tech is still immature. So there will be an obsolescence challenge, and there is risk in terms of backing the right technology and solutions. But the material supply is the challenge that battery tech is going to be facing. not just availability of supply, but also maybe a closer look at the energy intensity of production of batteries. These are areas where that are some of the challenges that the battery sector is facing. But in terms of demand growth, current supply is a very small fraction of demand and need. Whatever other alternative energy vectors sit alongside batteries is going to be an increasing part of the global solution.
Nice, thank you, Sam. We have a couple of questions about sort of what's going on in the markets. So we sort of touched on what technology is going to be important in the future, but there's one thing which is technology being released in the future, and then there's also the sort of market environment and the valuations. And the valuation picture has changed quite a lot, obviously, with rising inflation and rising interest rates. A lot of these tech companies, their valuations have come down a lot. And I was wondering, this is sort of for you, Stephen. I was wondering around sort of how do you now think about these valuations as sort of your mental model for what you consider to be the right value for a company changed, and how do you sort of diversify your portfolio still within the tech space to protect yourself maybe from no one you can really call the bottom, so we're not really sure where the market's going. So I was wondering if you could speak on that for a little bit.
Yeah, definitely, if you're in the market now, it's a very challenging environment just because the inflation narrative and also how the central bank in the US is going to react to the inflation narrative. And of course, the financial market or stock market is a byproduct of a function of the interest rate. So if you believe that the interest rate would need to go a lot higher than what's expected in the market, which is about 3 to 4% now, then you probably would expect the market have a lot more to go down from here. But if you think, according to Powell yesterday, he was suggesting that maybe the interest rate will stabilize at about 3 to 4% and expect inflation to come down from next year onwards, then the valuation that you're seeing now in the market is relatively attractive. And I was just doing some work on this recently. If you look at consumer staples sector in the US, which is everything that you know about, is the P&G, Europe with the Nestle, Unilever and all that. At the moment, if you look at the valuation of this company, they are quite expensive in the sense that, of course, I think the risk to the downside is a lot lower, because if we do go into recession, they're probably still going to sell their products. But if you just look at maybe 12-month forward, let's say earnings yield or maybe free cash flow yield of this sector compared to NASDAQ 100 index, which is many stocks that we would probably avoid, but just as a proxy, that they are trading at a very similar valuation. So you have NASDAQ 100 index trading at similar valuation to consumer staples sector in the US, just maybe 12 months from today. And of course, we all know, like for consumer staples sector, how fast they can grow in the next 3 to 5 years is probably a few percent every year. And equally for technology companies, that we know that they could easily grow much faster than the economy, just because we are forever more dependent in terms of maybe today's conference that is being held virtually, not in person. And I'm sure there will be many of these things that we'll be doing a lot more from here. And so I think if you're just doing like a relative valuation exercise, that you will probably say, yeah, at the moment, I think technology companies are pretty attractive. But I think going back to the first point that I made earlier is like the absolute valuation is a difficult one, because that is really dependent on whether the central banks are going to take the interest rate higher, and also it depends on your time horizon. If your time horizon is in the next 12 to 18 months, I think that is difficult. But then if your time horizon is in the next 3 to 5 years, then maybe I think the opportunity is getting closer.
And you sort of feel like you've sort of hedged your position a little bit recently with investments into Visa and MasterCard as well, to sort of maybe give yourself a bit of downside protection if inflation gets out of hand.
Yeah, we do like MasterCard and Visa. I mean, we have invested in this company for a long time, but recently, yeah, we have increased our position in these two companies. And of course, I think on one hand, everyone knows about them. They are powered by technology. I mean, even some indices would categorize MasterCard and Visa being technology company. I mean, to us, they are financial services, but they are very strong in technology. But at the same time, I think in the current regime, that if you expect inflation to remain quite high, or maybe stagflation, which means that we have higher level of inflation versus real GDP growth going forward, then MasterCard and Visa, they would do pretty well because they charge a commission on nominal spend from us, and so if the prices in the UK have gone up 10%, they basically charge a commission on 10% higher compared to this time last year. And then irrespective that, yes, our discretionary spend is going to come down because we have less money to spend, but they will benefit quite well. And so I think if you believe inflation is here to stay, which we do, for the medium term, then yeah, MasterCard and Visa, they would do pretty well from here.
And in terms of your portfolio, I think like the portfolio is pretty skewed towards the US, but then the US companies, are they sort of are getting, seem to be getting hit a bit worse? Is that still, you still think that the US is where you need to be if you're looking for these, most of the big sort of winning technology companies, or is that just is there any geographical preference, or is that just where you seem to find all of the best businesses?
Yeah, I think
is the case.
Yes, I think if you're referring to maybe the structural growth opportunities, in particular in the technology space, I think US companies would definitely offer you a lot more in terms of that universe, and the selection is a lot more diverse across the different end market base. And I think that there's a difference being, I think I've heard about this many times, like let's say the FTSE 100 companies pretty attractive in valuation terms relative, let's say the US market, which was quite expensive before, maybe relatively still expensive versus the UK market. But I think one thing you have to understand is, like, over the short term, of course, the valuation would play a role in terms of the return that you generate. But over the medium term is really about the earnings that they can deliver, or the share of the GDP they're going to have maybe 5 to 10 years from today. And I think I've looked at, I mean, a lot of the UK companies before I was a UK fund manager, and even though, let's say, commodities is doing pretty well at the moment, but over the medium term, you would expect that is not a big part of the global GDP. Technology is actually going to be a bigger part of the GDP even from here. So short term, you do get the headwind in valuation, which is what's happening in the US now in terms of the equity market sell-off relative to the UK. But then the underlying fundamentals of this company have not changed that much, for at least for the company that we have in the fund, and then you would expect them to continue to grow, maybe let's say 15% a year, 10-15% a year in the next 3 to 5 years. And at some point, the share price is going to come back to the fundamentals of the company. And then you realize that actually these companies are going to be quite dominant in terms of our day-to-day going forward. And it's not disappearing.
Yeah, I think the interesting point about sort of, there's been, people are quite bearish on technology, but like it's pretty much certain that technology is going to make up a bigger and bigger portion of our GDP as we go forward. And actually, as I guess the optimist in me thinks there's sort of two sides of this argument, which is a lot of this inflation has been caused by deglobalization, supply chain issues, but actually by digitizing the economy and doing more sort of digitization, you need less of the physical world, and you can do more online and less in the physical world. And actually sort of tech is actually a way for us to solve a lot of the issues that we're seeing in the world. Now, maybe Sam, it might be interesting to come to you in terms of how we can use technology in manufacturing and how it is being used, and maybe what you've seen recently in regards to what's going on with geopolitical tensions and nearshoring. And there's a lot of talk of deglobalization, and sort of how can we use, and what are the big bits of technology we can use to sort of make all these processes more efficient?
Yeah, so we're certainly seeing this nearshoring trend. There's a kind of national interest around security of supply for critical sectors such as defence, health tech, food, and from a UK perspective, we're seeing also a shortage of labour resources. So that's driving us to an increased demand for local content, and a shortage of labour is driving us towards technology. So there's a technology need to improve productivity performance. but equally looking at things like automation technology, using intelligent automation to fill gaps where we don't have workers, particularly in places like that, agri-tech space. So yeah, absolutely, we're seeing an acceleration, post-pandemic, and with the kind of localization supply chains, deglobalization are definitely driving an increased need and appetite for tech across the manufacturing sector. And I say that is largely around IoT and then analytics, AI type solutions. Also about visualization, so augmented reality type solutions in terms of providing remote training support. We start to stand up new supply lines. Some of that was used actually in the ventilator challenge during the pandemic as a useful technology where we have trying to scale rapidly from a small expert base to a large production volume where you don't currently have the skills and infrastructure in place for remote support and training. So yeah, increased investment in IoT, in intelligent automation, robotics. Lots of interesting new robotics and automation companies come onto the market as well, looking at beyond the traditional industrial robotics and cloud analytics and AI is certainly where we're seeing investments to drive security, deal with uncertainty and demand as well in factory, and I think we'll see that moving into the way we manage supply chains as well. So currently, the state of the art in tech development across industries generally in-house, but also looking at supply chains, more sophisticated, agile supply chains and platforms where we can connect companies, B2B matching, etc. That's going to be an interesting growing space as well of supply chain connectivity. So yeah, the other thing to think, the other trend to think about is around decarbonisation and sustainable manufacturing. So big challenges there around data, transparency of emissions footprint through supply chains. So technologies that are providing transparency, maybe blockchain-based solutions, but anything that's about carbon accounting, providing first of all the insights, but then you're going to be looking at tech solutions to reduce footprints, carbon footprints. So anything that's related to green infrastructure, and some of that is actually decarbonising traditional industries. It's not all about new green tech. It is about better control and substitute fuel switching for heavy industry as well. So that the decarbonisation trend is another key trend we're seeing alongside deglobalisation and some of the post-pandemic response, which led to an increased investment in tech, largely IoT, AI, and advanced automation.
Do you think it's sort of the case that maybe some of this tech has already existed, but companies need the cost pressures to come in to be fully kicked into gear to say, oh, actually, there's technology out there that can help ease some of these pressures on our business, and then it sort of kicks them into gear. And they're not all perfect. They're not always trying to optimize 100% all the time until there's a real incentive to do so.
Absolutely true. I mean, that's certainly something the pandemic showed us. A real change in the appetite. There's lots of reviews of UK industry in terms of investment in digital and tech to improve performance, and it was driven by necessity and a recognition. And I think even now we're nowhere near saturation in that investment in tech. We're going to see still the early adopter businesses and larger companies are making those investments, and there'll be, I think, a big market for making tech, make it more accessible, making it easier to derive value for smaller firms, which is a broad base of the industrial base. So platforms that provide interoperability, easy to access data, derive insights, and improve performance from data are going to be huge. And a lot of those solutions were out there, but it's I think accessibility, so the platforms make it easy to access and derive value, are growing.
I'm curious about, in terms, because you work in the UK, do you know how the UK sort of stacks up versus other major advanced economies? Are we particularly progressive with our tech use in manufacturing, or is there a lot of businesses, there's still a lot of sort of area for growth, and there's a lot of businesses that aren't optimizing at the moment? And sort of compared to maybe the US or Japan or Europe, there's a bit
of juxtaposition here because broader tech, as leading, the largest in Europe, third in the world in terms of the UK tech sector, but deployment of that in manufacturing, we lag actually behind our majorly industrialized peers. So we have traditionally lagged, and that we're seeing a kickstart change in that since the pandemic. businesses committing to invest and recognising the need to stay competitive, but also because of the shortages of labour and this desire for increased local content, which means you have to automate the copying skills in. And so it's shifting in the right direction, but the UK has lagged. But we have an interesting position where we've also underinvested in skills for a few decades in manufacturing. So you've got the knowledgeable workforce that make systems and processes work who are coming to end of career. You've got the kind of data, digital natives coming into the workforce who are keen to work in a new way and adopt technology. So both the fact there's the lack of experience coupled with a new wave of workforce coming in and an availability of data and tech means I think you might see a rapid shift and rebalancing of deployment tech across the UK.
As a sort of like Katrina said about the healthcare, it's just like with these demographics coming through who are more comfortable with using technology and using computers and stuff.
Yeah, absolutely. But also there's a gap because there's not enough people to deal with demand doing it the old way, which is about experience and know-how. So tech has to be the answer because to deliver the volume that we have to, we need to look at new ways of working and the workforce coming through. Absolutely, and natives, and that's where they would look first of all. Seen great examples of that. You've got apprentices coming through who are programming and installing robot cells, whereas 10 years ago they wouldn't have got anywhere near the cutting edge technology facilities. So there is a shift in terms of where the need lies, where the innovation is coming from, and some gaps in terms of capability and capacity are probably pushing and accelerating us towards tech investment as well as that demographic trend.
It's nice to know. Yeah, the optimist in me hopes that sort of what we're going through at the moment hopefully drives the next generation of investment, and hopefully we get better at doing what we were doing before.
There's also the opportunity to connect the strong broader tech sector in the UK to the manufacturing sector because of these demographics and dynamics I've talked about. There's a great opportunity. We're seeing some exciting new startups and scale-ups coming into the manufacturing space from AI, IoT, UK-derived companies, partly because of this unique demographic we have of the shortage of skills and a need for increased investment and scale-up of manufacturing capacity.
And as the government, I know HVM gets a bit of funding from the government. Is our government fully sort of committed to this sort of upskilling?
Yeah, absolutely. Yeah, there are things coming through the system that certainly recognise this is the future of manufacturing in the UK. There's a resilience element to it as well as the economic growth opportunity. But equally, a great opportunity for these digital firms tech firms in a manufacturing environment using their teeth in the UK market and going global. So there's quite an exciting ecosystem developing of tech companies looking in the manufacturing world, and government is very much supportive of that and recognises the skills challenges and the need to invest.
I think we've got a question for Katerina here. Thanks very much, Sam. Katerina, the question is sort of with respect to ESG focused fintechs, sort of what are your thoughts on their growth trajectory?
So yes, for me, this is a massive growth in the coming years, mainly because let's just put this back into context. What is ESG? Is sustainability, and sustainability is mandatory. Otherwise, our life quality will decrease significantly in the coming years, and eventually we are going to die. So the rationale is pretty much a no-brainer for this. What is happening at the moment at ESG is ESG efforts are mainly driven by governments through the financial system, because this is where they have a handle via institutions like the FCA and the equivalent in other countries. Now ESG is managed very differently from one geography to the other. In Europe, like in Central Europe or continental Europe, more like that. This is really a mandatory regulation that is pushed by the European Union upon financial institutions. So this is mandatory, this is a law. While in the UK, in the US, in the Middle East, these initiatives are not mandatory, and the pressure is not necessarily coming from the government, but more from the consumers and the investors. So the result may be the same, however, the pressure points are different. This being said, the US government has already announced that they will use the EU Sustainable Finance Initiative as a blueprint for their own reflections and their own initiatives. So this being said, of course, then fintech will come up with solutions. So I'm personally the chairwoman of a fintech that works in that space, more specifically around the EU taxonomy, which is just a little part of the sustainability efforts of the European Commission. And already this regulation is an absolute beast. So to get through that, to get banks to actually adhere to the criteria that is put out by that regulation is a tremendous amount of work. I see this on a daily basis with the operational teams and the banks that we are working with. It's extremely complex. And fintech have their main value proposition is to take complex things and make them simple for banks or for financial institutions. And I think that this is where their USP is in this.
Interesting. Have you got any sort of how does the fintech businesses sort of exactly work in terms of helping sort of streamline the ESG process, help these banks manage these huge complex regulations?
So I think that what banks facing at the moment with these regulations, and I can be very specific about the EU taxonomy because I know that field very well, is once again, they get this regulation that is like 90 or 100 pages. I've tried to read through it. I probably need to read through it like 15 times more to get all of it, right? So banks are faced with that regulation that is entirely new. It's not like MFID or any other regulation that has been on the market and updated over and over again. So there's like already a little bit of knowledge internally. So this is entirely new. What happens then is the bank is like, oh my God, how are we going to comply to this? And then fintech usually come in and say, how can we make it simple for you? This is the main USP when it comes to, breaching the gap between that type of regulation and a bank that certainly has the resources, but not necessarily the knowledge. And it also takes them a lot of time that fintech can actually change. And regulation, if you don't comply to it, at one point in time, it's going to hurt because you're going to get, it's going to happen sooner or later.
Yeah, certainly. And do you think once you sort of have, once you have some bit of technology, it can also be easily malleable for other bigger regulations that come down the road as well? Or is it sort of the company specific?
It should in any fintech. That's certainly our aim, but it should in any fintech. And I mean, once again, for me, the main USP of any fintech should be to make complex financial processes easy. May that be for end consumers or for banks, regardless at which end you're positioned. For me, that is the main USP of any fintech.
Great, thank you. We've got the we've got the poll results in, and I think Stephen, the poll results said that technology stocks have appreciated too much and overvalued 67%, and 33% think technology stocks to grow as we seek more innovation. Or maybe the poll results have gone slightly against what what you said. Have you got sort of can you make a case to the, in the law, we've got 5 minutes left, maybe you can make a bit of a case to the listeners as to why the 33% are in the right and the 67% might be in the wrong.
Yeah, thank you for that. So maybe I just go back to the first point I made at the beginning was about, let's say, Netflix on a TV streaming or maybe Amazon on e-commerce. I think the reason that we didn't like both companies wasn't because of the bigger trend, which I think is going to be in place and will become even more prominent from here. It's about the competition within the space, that you have many more players within those space. So I think the one thing that is quite clear, I think everyone is now addicted to maybe TV streaming, whether you're doing it through Netflix, Disney Plus, or Now TV. There's so many options out there. That is not going away, right? So, and that has not been the case before the pandemic. So that part of the world is going to be much bigger. It's going to become much bigger part of our day-to-day going forward. And so I think that is where the growth opportunity is going to come from. And of course, then you need to pick the right companies to capture that. Otherwise, then you might not be able to make any money from a shareholder perspective. To go back to the other point about valuation, is it depends on what we are talking about here. I mean, there's certain companies that are going to disappear. I think I have made many points about Peloton, maybe early this year or last year, is that the technology that they have is not proprietary. And if you look at the balance sheet, they're going to run out of cash pretty soon. And they employ about 5,000 people globally. And some of these companies, like, even though if you look at the share price, it's down 90%, which I would definitely agree that they are very much overvalued, because the company can worth zero if no one is going to come in to maybe acquire them in the next couple of months, etc. But I think equally, if you are referring to some very high technology companies such as like Microsoft, which I mentioned earlier, the shares is down about 25% year to date, and the market S&P 500 index is down about 20. But then the 25% downfall in Microsoft shares in the next 3 to 5 years, I think, is going to be immaterial, because they are going to grow their free cash flow by at least 15% per annum in the next 3 to 5 years every year. So I'm sure that if you give them enough time, and also the technology is going to be going to be quite embedded on our day-to-day, that they are going to make back that 25% that we have experience that reset. So I think it really depends on the company that you are looking at. Some companies, they are not worth what they're looking at, so I agree with that. But some companies, they are probably being penalized on an indiscriminate risk-off or sell-off in the market. So I think you want to be really specific in terms of where you put your money in from here.
So I think we're sort of, what we're taking away is there's growth potential in ESG and fintech and medtech from Katerina, and in sort of manufacturing tech from Sam and Stephen. You see lots of opportunities still, but do you think, although we've sort of, there are these companies that can grow, for investors, is it more important than ever also to be interested in sort of, do they have strong balance sheets? Because with these, it's gonna be harder to raise capital, isn't it? And with interest rates going up, it's gonna be harder to refinance loans. Do you think it's a case of tech is still here to stay and it's going to drive future growth, but we need to sort of look for the safer tech stocks rather than maybe last year or 2 years ago, people were happy to go for Peloton or Netflix, which had quite shaky balance sheets?
Yes, I think 100% correct. And I don't know if anyone have followed WeWork, just to put it in for a laugh, is if you look at the WeWork's valuation in the market cap in the about $3 to $4 billion market cap. If you look at the debts they have, which is mostly bank debts, it's about over 20 billion debts they have on all their leases. So you're talking about a company that in the market is 3 billion, but then they have over 20 billion dollars of debts. I mean, that's a lot of debts that they have. And of course, if you look at the business model, is not that high end in terms. Is quite the barrier to entry to just start up another office sharing space is quite easy, and many companies have done that. So I think for those companies, yeah, they will struggle massively. But then equally, if you look at like Microsoft or Google, like Google just announced they're going to spend like $70 billion to buy back their shares, which is equate to about 5% of their market cap. I mean, that is just spending money to buy back shares because they feel that the valuation is quite attractive. So they're not going to be in trouble anytime soon, and they're probably going to come out from this much stronger, while some of the smaller players is going to disappear from this point onwards.
I think thank you very much. I think we might be wrapping up soon. So appreciate input from all you guys. It was very good chat. Thank you very much, Katerina. Thank you, Sam. Thank you, Stephen.